I just saw a video and it was highlighting some of the most recent breaking news from China that's predicted to be a direct indicator of potential trouble for the United States, for the US dollar. In addition, China, Japan, and Saudi Arabia are mentioned for their actions related to U.S. treasuries and gold purchases. Plus, China and Saudi Arabia are reported to be selling off U.S. treasuries and buying gold instead now. So in this video, the host then raised concerns about the future of the U.S. dollar and its impact on the U.S. economy. And they mentioned declining U.S. dollar dominance before emphasizing a paid promotion and video sponsorship that just so happened to be a gold development company who paid them $500,000 to represent their company in their YouTube videos, but also failed to disclose this to viewers as there's no mention of the video including a paid promotion, especially since YouTube requires this disclosure for the safety and moral, transparent responsibility to its viewers. Nonetheless, however, the gold company is peddled to the unsuspecting viewers as a potential investment opportunity, and they go on to share updates on recent investments by notable figures in the company, underscoring their optimism about gold investments. And honestly, I must say it was a well-crafted and strategically planned out delivery that almost felt real, and as if the actor was really speaking directly to me and cared about me and my own personal well-being. So now I want to give my own reaction to what I just saw and talk to you more about the Financial Times and the debt-fueled bet on U.S. treasuries that's scaring regulators, and how policymakers are concerned about the huge leverage that hedge funds are employing as part of the so-called basis trade. Plus, Bloomberg and the treasuries extend sell-off, pushing 10-year yield to 16-year high. Oh, and before I continue further, happy fall, everyone. All right, so as asset managers have increased their long positions in U.S. treasuries, hedge funds have piled into the short side of the trade, and heavy government borrowing has driven a big expansion of the U.S. treasury market. So right now, regulators are closely monitoring the 25 trillion U.S. government bond market due to a rapid buildup in hedge fund bets in the treasury market. And the basis trade involves playing two very familiar debt prices against each other, extracting gains from the small gap between the two using borrowed money. Meanwhile, the Bank for International Settlements, the BIS, and the U.S. Federal Reserve have both expressed concerns about this strategy, which could pose a financial stability vulnerability and have the potential to dislocate trading. And I don't need to remind you that the U.S. Treasury market is a critical component of the global financial system, and its potential dislocation could cause broader market turmoil overall. So many hedge funds argue that they provide liquidity in the market and are essential to its functioning, but regulators are cautious about the risks associated with this leverage strategy, and some market participants are concerned about moral hazard due to the belief that the Fed will intervene to stabilize the market in instances of extreme instability. Now, let me share with you how the basis trade works in case some of you are wondering. All right. Number one, the start of the trade, or the start of trade, hedge fund buys U.S. Treasury bonds. It borrows cash from its prime broker, and the prime broker holds the treasuries as collateral, known as a repo trade. And just so you know, repo is a form of short-term borrowing for dealers and government securities. In the case of a repo or repurchase agreement, a dealer sells government securities to investors, usually on an overnight basis, and buys them back the following day at a slightly higher price. That small difference in price is the implicit overnight interest rate, and repos are typically used to raise short-term capital, and they are also a common tool of central bank open market operations. So for the party selling the security and agreeing to repurchase it in the future, it is a repo. And for the party on the other end of the transaction that's buying the security and agreeing to sell it in the future, it is a reverse repurchase agreement. And this is what occurs during the transaction from treasuries to hedge funds to prime brokers to trading counterparties as we move towards the end of the trade. So next, hedge funds now have cash to use while keeping a long position on treasury bonds with their prime broker. And this is called repo leverage. At the same time, hedge funds enter short futures contract on those securities. Some of the more popular and widely known hedge funds include company names that may sound familiar to you, like Bridgewater Associates, Renaissance Technologies, AQR Capital Management, Two Sigma, Millennium Management, Citadel, Tiger Global Management, D.E. Shaw, Davidson Kempner, and BlackRock. And in all fairness, BlackRock is not a hedge fund, but instead BlackRock Incorporated is an American multinational investment company based in New York City, founded in 1988 initially as an enterprise risk management and fixed income institutional asset manager. And BlackRock is the world's largest asset manager with nearly $10 trillion US in assets under management. And BlackRock is the same asset manager company tied to their secret star money manager, Alistair Hibbert, who earlier this year was raising $1 billion for his hedge fund following the worst ever annual loss for his equity-focused strategy, the BlackRock Strategy Equity Hedge Fund. So, Hibbert oversaw the BlackRock Strategy Equity Hedge Fund, which grew to almost $9 billion US from betting on and against US and European companies. And at one point in time, since launching, it more than tripled the gains of other long, short equity hedge funds, many of which now face an existential crisis as they trail well behind the longest bull market in history. And Hibbert has often been the firm's highest paid employee globally. And in recent years, he earned a 9-figure sum, which was more than triple the size of CEO Larry Fink's over 30 million US, or 39.8 million to be exact, payout according to Bloomberg estimates. All right, so we continue on in this basis trade. Hedge funds now have cash to use while keeping a long position on treasury bonds with their prime broker, and this is called repo leverage. At the same time, hedge funds enter short future contracts on those treasuries. As part of these futures contracts, they promise to deliver treasury bonds to their trading counterpart at some point in the future, and they make money if the value of treasuries implied by futures decreases. So next, they are now long actual treasuries held by the banks, and also short treasuries via futures. And as the futures reach expiry, their value decreases slightly to converge with the cash bond market. And hedge funds deliver the promised treasuries on the day of expiration of the future and pay back their bank. In the end, they make slightly more money by delivering the treasuries than it costs to borrow from the banks. And this is going back to the brief chat that we had on a previous video about leveraging banks, loans, and debt for greater returns and profit. And as of this morning, U.S. treasuries have experienced a further decline, pushing 10 and 30-year yields to multi-year highs. And this comes as the Federal Reserve is expected to keep interest rates high and the supply of new bonds continue to increase due to mounting government deficits. The 10-year yield rose to 4.54%, the highest since October of 2007, while the 30-year yield reached 4.66%, a level not seen since April of 2011. And the bond yields have been climbing since the Fed last week signaled the possibility of one more rate hike this year and reduced expectations for rate cuts in 2024, indicating a likelihood of maintaining tight monetary policy to curb inflation. And with Congress just days away from a government shutdown, we could likely expect to see rates go even higher, some say. And when compared to the last decade to millennials and Gen Z, interest rates are high, but to other generations before, it's not. Meanwhile, to savers, doesn't matter what generation, increasing interest rates are welcome. And the real problems are the increase in the prices for homes and cars, and for those who don't pay off their credit cards on a monthly basis. Slow reactions and adjustments generated by poor fiscal policy that allows no cap on car loan, credit card, and payday interest will surely hurt most Americans. While other countries like China, Japan, Saudi Arabia, and the UK are planning and preparing for the likely consideration that the Fed's actions have nothing to do with this at all, and that maybe the world in general is starting to wonder that those debts may not get paid back. So they're steering clear of them instead. So will I be buying U.S. treasuries anytime soon? I highly doubt it. And will I instead invest heavily in gold and other more secure bets against inflation and total economic failure and collapse at the hand of the U.S. government and its officials? Absolutely, yes, 1,000%. Thank you all for watching. And if you want to join us as a channel member to continue these conversations and just help to support my research that allows me to continue bringing you valuable content, then just click the join button below or the included link in the description. And until next time, remember to keep your money safe and make it grow.